Hello everyone, this is Kathy McBreen of the Spectrem Group. We're here to discuss with you the findings from our Spectrem Investor Confidence Index for the month of September. Actually, it's dated October because it comes out at the beginning of October, but it's reflecting the views of investors at the end of September. I'm here today with George Walper, the president of Spectrem Group, and he will discuss with you the investor confidence update, and then I'm going to talk to you a little bit about some of the findings in our comprehensive bank trust update, which I think you'll find really fascinating. So with no further ado, I will introduce you to George.
Thank you, Kathy. Hello, everyone. The last 12 months have been quite interesting. If we think about where we were a year ago in the throes of the presidential election, we clearly have come a long way relative to both the financial markets and therefore our index overall. As a refresher, for those of you joining us and viewing this the first time, each month we do research with millionaires and overall wealth market affluent investors and ask a series of questions about how they're feeling about the economy, how they're feeling about their investments, what they worry about, how they feel about the next 12 months. And the results, as Kathy indicated, are released to the market on the first business day of the month. So this is September's research results that were released on Monday, October 2nd. From a year ago, and put in context where we were a year ago, as I said, for the election, you can see September 16th to September 17th for the Millionaire Investor Index was down 14 points compared to where we were a year ago, which is kind of interesting given the election. Especially interesting as those of you that follow this every month, right after the election, things continued to move quite positively. And then compared to last month, August, it was up 9 points. The affluent index overall down below was up 6 and 9 points respectively. Now, the Millionaire Index has taken some interesting turns the last June, July, and August months, and we can see a little bit of that on the next page, where the top lines here reflect the last 12 months, and the bottom chart goes all the way back to the inception, 2004. But if you look at what the Millionaire Index has done, which is the light blue line, it typically and always has, with a few exceptions, and you can see one of the exceptions being in May of this year, but it typically is more optimistic than the overall wealth market, with some variations and drops, etc. And so it's been a very interesting post 12 months, especially post 10 months or so since the election. One of the key components that we feel is worthy spending a little bit more time each month looking at and understanding is a component of what folks view for their overall outlook for, I essentially call it their life. We call it the affluent household outlook. And you can see that's at our statistical number of 30.1, which is the highest level it's been in a year, and getting close somewhat mathematically to where our high point was in 2004. The subcomponents of this are what I think are critical. The left side here, the top left, is the overall. So the change from August and change from a year ago is pretty positive. How folks feel about their household income today versus a year ago is trending upward. What they feel about the economy, and the economy, for those of you that followed us throughout the election year, the economy was the biggest difference during the election between Democrats, Republicans, and independents. Throughout the pre-election year, Democrats were very optimistic about the economy, and Republicans were pessimistic. Independents were in the middle. The month after the election, that flip-flop, with the exception of independents remaining in the middle. And then company health is a measure of what folks think either about the companies they own or the companies that they work or worked for. And then overall household assets. So generally speaking, everything is trending upward. Even the company health down 1.2 points is a somewhat minor decrease from last month. The most serious threats to these wealthy folks' household financial goals, the political climate, because it's such a visible thing, both in terms of the media and then some of the most critical factors happening in the world in the last 3 or 4 months, in particular with North Korea, as you know. But secondly, how the media covers everything that takes place in Washington. And then overall market conditions, even though the market continues to be trending upward, continues to be near or at record levels, obviously the concern would be, will that continue? Here we take a look at the trend about these various factors going back to June of 2016, a year and a half or so, or actually 15 months of insights. And so you can see unemployment levels were spiking up there for a period of time early last year, mid to last year. But essentially the political environment's been pretty high, as have stock market conditions. The second biggest category that I think is important to look at, in addition to their overall outlook, is what their intentions are or preferences are for investments by major asset categories, equities, fixed income, and short-term and/or real estate. Compared to a month ago, equities continue to be pretty favorable, and compared to a year ago, both in pretty good shape. A little bit down August compared to a month ago for equities and mutual funds, but nonetheless still pretty good. A little bit lower than where they were in 2012. We're always intrigued by stock mutual funds compared to equities, where stock mutual funds were down compared to higher than last month, and yet individual issues were a little bit lower, but nonetheless equities still are fairly positive. And mutual funds are getting towards the all-time high in 2004, February. Fixed income, you can see bonds continue to be a little less interesting. That has a lot to do, as you know, of course, with the interest rate environment. And where short-term positions are way lower, not surprisingly, for March of 2009, and continuing to drop, showing folks willing to deploy their liquid assets into the markets. So we're going to shift, and Catherine's going to talk about research we do every year in the bank trust market, the utilization of trust by wealthy investors, and some key trends in that marketplace.
Thanks, George. I think that this is important information, and what I would call it is not just the bank trust update. I would call it the bank trust disaster, because the bank trust market is losing market share so rapidly and really declining. And there's really no reason for it, because we're in an atmosphere in which the baby boomers are transferring their wealth. Trusts are perfect for that. Secondly, there are lots of issues around fiduciary care, and that's all something that we should be thinking about in the marketplace as well. So it doesn't make any sense to me that these trust numbers are so bad, but partly it's because of their unwillingness to change according to the environment. So we're going to talk a little bit about that in the next few slides. So as you can see, this first slide is a slide about the personal trust assets. And as you can see, they declined in 2016. All of this information is as the end of the year 2016, and that's because of how long it takes the government to report all of this type of information. So then we take it most of it from the government, and then we also compare it to some of our own data that we've been collecting over the years. So as you can see, in 2016, $892 billion of personal trust assets. But the most important thing is that these numbers are down when at the end of 2016, the stock market was at a record high. The other thing that you should note is that, so this trend kind of started to happen earlier in the, let's say, century, where you can see in 2001 and 2002, the trust assets were starting to decline, but then they started to go back up in conjunction with what the market was doing as it went. And so you can see in 2007, trust assets were at their all-time high. Well, after the market crashed, the trust assets in conjunction with the market declined in conjunction with the market, but they never recovered as the market did. So this is a real issue for the trust companies, because clearly these assets moved to someplace else. Either that or they're really, really bad asset managers. Secondly, this slide shows you the number of managed versus non-managed personal trust accounts. Now, as many of you know, investors in general do not think that trust companies are good asset managers. We've tested that, and we've done some studies regarding that. And this reflects that attitude. As you can see, the number of managed accounts continues to go down. And clearly, bank trust departments want to manage accounts because that's how they make more money. But this trend just isn't happening. In contrast, in addition, if you look at the bottom line, you can see that the non-managed assets are just pretty much staying stable. So these are the non-managed trust accounts. They're really pretty much stable. Instead of saying to themselves, trust companies saying, oh, we can become more effective and we can maybe cut some costs and maybe form relationships with these clients and, provide custody for them until something happens, and then maybe we can provide greater relationships as things happen to the family. The trust industry has generally decided to ignore that. So as you can see, they're continuing to decline, and where they might have some opportunity in the non-managed space, they're not growing that business. The top trust companies have remained the same in basically the last 10 to 15 years. As you can see, most of the assets are held within the top 10 trust companies. And then the smaller trust companies have a smaller share of assets, not surprisingly. We do see some growth actually in this very small market where you see the 51 plus, those in the ranks of 51 plus. There's a little bit of asset growth in those smaller companies, and that may be because they're reaching out or working with local RIAs to actually increase their asset management capabilities, or at least to increase the amount of assets they have in trust, working in conjunction with others. The bank common and collective fund assets did increase, but part of this is because the bank collective funds are mixed together. We can't tell you which part of the FDIC does not separate the reporting on these, so these are both bank common funds and collective funds. So the retirement funds are linked in with the numbers that we're able to report in this. So not surprisingly, these assets did grow. This chart will show you the actual gross income coming from personal trust. And as you can see again, in most cases, except for the case of Regions Bank and Citibank, the gross income from personal trust was down across the industry this past year, especially for the top 10 banks. When we ask investors whether or not they have their assets in trust, you can see that not as many people have a trust as you would think. Only 44% of those with 5 million plus have assets in trust, and only 58% of those with more than 25 million in assets have assets in trust. This is kind of a small number if you think about the types of assets these people have. Now, granted, with the potential decline of the death tax, you could see some of these numbers being reasonable. However, there are lots of complicated assets that are involved with many of these families that really would fit well within a trust, as well as the overall care that you need for your family in the future. How are you going to manage the assets once you pass? So trust has to be pursued not just as a tax shelter, but as something that provides value to a family or helps a family meet its financial goals. On the right-hand side, you can see that not very many individuals actually use a financial institution as a trustee. Only 14% of those with 25 million and only 9%. This is fine because people don't feel comfortable appointing an institution as a trustee to deal with issues regarding their family. However, there are lots of administrative issues that are involved in having a trust, and there are also the issues about what happens when the trustee or the family member that you've appointed as trustee upon your death, what happens when they pass away if there are still assets left in this trust? What happens then? So there are a lot of unanswered questions that people don't realize, and that there are lots of opportunities available to bank trust departments if they're willing to act as a co-trustee or to wait to be the successor trustee and help out with these administrative tasks along the way. Just to kind of provide a little bit of flavor, we added some information from some of our wealth studies asking people about these top 10 trust companies. What are their attitudes about these firms? We asked them, do you think these firms are trustworthy? Do you think they're innovative? Do you think they're talented? And do you plan to use them in the future? And then we compared them with the companies that actually rate the highest among investors in these specific categories. As you can see, as far as being trustworthy and transparent, most very large companies are most very large trust companies are considered very trustworthy and transparent. So that shouldn't be surprising. They shouldn't be in the trust industry if they're not considered trustworthy. All of these companies have a rank highly, but it's interesting to note that the BMO's private bank, the MyCFO kind of part of the bank, ranks very highly as being very trustworthy. But when you look down below at the top trustworthy and transparent firms, the top 3 noted by investors in general weren't any of these top 10 trust banks. They were Vanguard, Fidelity, and Schwab for the ultra high net worth, and Alliance, Bernstein, Fidelity, and Schwab on the very wealthy front. Same with innovative products and services. Again, many of these banks don't rate that highly as far as being innovative. The 25 million plus investors do feel that BMO's private bank is innovative, and Chase and Bank of America are. They're a little more out there with their ratings than the ultra high net worth. But again, at the bottom, for the most part, none of these banks fall within being innovative, with the exception of my private bank at BMO. As far as talented advisors and staff, you do have to give Northern Trust some credit here. It ranks as one of the most talented advisors and staff by the ultra high net worth. But again, on the 25 million plus side, it's all the high-end brokerage firms that are ranked the highest. And who are you going to use in the future? I have to note that Key Private Bank popped up on this chart, which was kind of a surprise. Not that, no offense to Key Private Bank, but they're not one of the top 10 banks. But they did pop up as one of the top 3 firms that some of the 25 million plus are thinking about using. So that was an interesting finding. So overall, again, you can see that the top 10 trust banks are not the ones that wealthy investors are thinking of using the most in the future. They're really thinking of using more Vanguard, Fidelity, or Schwab. So I wanted to so those are some of the findings from our trust update this year, really pointing out to them it's time to get on board with rethinking your strategy and figuring out who you're going to be in the future, because there's lots of opportunity there. So I'm going to turn this back over to George to conclude this webinar and talk a little bit some about insights.
Thank you. The trust industry has been historically a critical part of the wealth management industry and provides a critical component of services to wealthy investors. So it is interesting that the trends in that industry, for that part of the industry, continue to trend downward. Each month we produce our Spectrem High Net Worth Insights newsletter, designed for any professional who provides products, services, advice, investment to the wealthy investor. It's great as a corporate subscription. It also is where our index that we just went through is released every month on the first day of the month. This is provided to everybody who subscribes to that. The lead story this month is research we did in-depthly with doctors about what doctors say about their advisors, who they hire, who they utilize. Doctors are a key segment of the professionals that the industry goes after, as well as a number of other stories. There are highlights from some of the trust research we just chatted about, and a little bit look at educators as a segment. So we always like to pull from interesting research of ours every month, as well as the index. We thank you very much for joining us today and look forward to talking to you in the future.